Wilfred, it's really interesting. So many of us came on TV and said that if the Fed cut rates, it would scare the market because it would mean they know something. The bond market already knows something, and the markets have called 8 of the last 5 recession is a common joke we use. The Fed has called 0. So, the bond market has already reflected what the Fed is going to do, which is a stimulative effect. So today is just basically answering that question. The market has commanded a Fed rate cut, and, when you got a little bit of flexibility out of Powell today, Fed Chair Powell, it's obviously reacting into an oversold condition as well.
But Tony, given, as you say, what the bond market seems to have already priced in, does the equity market now, in fact, require a rate cut to stay where it is, as opposed to see a big jump if and when one is delivered?
I think so. Well, that's the risk to my fundamental story, and the reason for our bullishness since the end of last year is that you have slower economic growth that's slow enough to cause the Fed, very similar to 1995, slow enough to cause the Fed to actually fear that inflation is going to go down too much and actually cut to prevent an inversion of the yield curve on the 2-10 yield curve. So I do think you're going to need a cut because the fundamental data warrants it. And, I think it's real. What the most important point is that the viewers realize this bull story is not about an accelerated growth path in the first half of this year. It was always a weak enough growth to make the Fed. They made a communication mistake and a policy mistake at the end of last year. They fixed the communication mistake with a dovish pivot that created that breadth thrust early in the year. Now they need to fix the policy mistake. So it's not like this economic Armageddon's coming. It's just they need to fix the error that they made last year.
What about tech stocks, Tony? They're on top today. They were on bottom yesterday. Serious concerns about prolonged antitrust investigations for the leading group in this market for the almost entirety of the bull market. What do you do with those stocks, and can you trust a rally if they're going to face political and regulatory pressure?
That's a fantastic question because, as you guys know, Sarah, that my whole thing is about the 1995 analog where the Fed went from nearly inverting the curve in 1994 to actually going from the last rate hike in February 1st of 95 to cutting rates in early July 6th of 1995. Very quick shift there. The same thing is happening this year. Tech led into that rate cut. After that, after the rate cut in July 6th of 95, tech underperformed hugely. Semiconductors in the second half of 1995 were down 40%. 40%. The market still went up 15% more. So that was one of the best years in the history of the S&P was 1995.
So you don't need them. Is that what you're saying?
That's basically what I'm saying. It's not that they're going to tank. The semis were under pressure then, but tech can pause here and have a little bit of a pullback as it's having, and other groups can take the lead.
Hey, Tony. So it's Steve Grasso. Thanks for taking my question. Longtime fan, first-time caller, Tony. So question for you. Right. Question for you. Can the Fed buy themselves some time if they just stop QT right now? And then they could push off, to Wilf's first question, they could push off that rate cut. Because I think the market would scream to new highs if QT ended tomorrow.
Honestly, Steve, that may make the sentiment of the market really tick higher. I think it's all about the Fed. I don't think QT, as we've debated before, I don't think QT, and I can't find a banker that's told me that QT has affected the liquidity in the market. It's more about the fear of liquidity that it brings in. So the announcement might help, but ultimately what you need is to incent banks to lend. Banks have too much money on reserve at the Fed. That's why the Fed is trying to raise the interest rate on reserves at the Fed.